Hey guys, Austin the Money here. Today I'm going to talk about is it possible and is it easy to beat the S&P 500's average return of 10% a year? So I think it can be easy, right? So as you can see, I own Enphase. I bought it at 100 and it immediately fell 9%, but I sold an in the money covered call, which is a very, very awesome strategy. You guys should learn if you have not learned it. It's a very good hedge, and I mean the premium, $955 for the premium. But anyways, with these trades that I have going on, if Enphase expires over 95%, my October return will be 3.3%. And if Enphase expires below $95, my October, I will collect this full premium of $955, and my return for October will be 5.3% in premium, right? So of course I'm going to have an unrealized loss in Enphase, but I would just keep selling $100 covered calls. That way that unrealized loss never actually becomes realized. So I'm looking at either a 3.3% gain or a 5.3% gain. And if you do the math, I mean, my goal is 2% a month. That's my minimum goal, 2%. You look at that, that's 24% a year. I mean, that's almost 2.5 times what the S&P 500 can get you. And I feel like my plays are pretty conservative, minus this Enphase trade. But I feel like my Tesla put, I sold this 205 put when it was at like 246. I'm sorry, it was like 244. And the SoFi put, I sold these $8 when it was like over 10, a little over $10 a share. So, I mean, it'd have to fall 20%, and Tesla would have had to fall 20% for these to even get in the money. So I feel like that's pretty conservative. The Enphase, I had some capital that I freed up, and Enphase had earnings, so I decided to kind of play around with with this trade. But before I even got into Enphase, and just with the other trade that I had earlier, I was set to make, I think it was 2.3% or 2.4%. It was still over my 2% goal, which is my goal. So that's awesome. And like I said, that's 24% a year, while the S&P is bringing you 10% a year. So is it possible? You know, I'm started this journey right around September 1st. So I will definitely keep you guys updated, and hopefully next September 1st, I will make a 1-year video update of my 1-year returns. And if it is over 24%, then I would think that I'm doing pretty well. And the cool thing with cash secure puts is even if you're in a bearish market, you're still hedged to a certain level, right? So like if instead of me buying Tesla and selling covered calls, I'm selling a put. That way, if Tesla fell that 20%, that would not affect my account at all. The only risk I'm taking right now is with Enphase. And the only reason I'm taking that risk, if you go year to date, I mean, less than a month ago, they were at 120. Now they're at 91. It's looking like it's going to get a dead bounce. If you see, when it falls sharp, it bounces back up sharp. Falls sharp, bounces up sharp. Fell sharp, bounces up sharp. Fell sharp, bounces up. It's a trend with this stock, right? And on top of that, their earnings, if you can see, it bottomed out Q1 of 2024, and we're back on the rise. So their earnings are going to be growing now. The interest rates are getting cut. This company's already bottomed. Okay, the earnings have already tanked as much as they're going to tank, and now they're just growing from here on out. And depending on how this earnings comes out on October 22nd, we'll see how fast they're going to keep growing. But their growth rate is going to speed up. And when they had a high growth rate, if you guys look back, this is what happens when they had a high growth rate, right? I mean, we're looking at 180s. I think they topped out, well over $330. This was probably a little overpriced, so even like 180s. I mean, like, this is still doubling the stock price from there. And it looks like we've literally been trading sideways this whole entire year. Shit, actually, for the last 12 months, we've been trading pretty much sideways. So I feel like this is a lot of good consolidation. That means there's a really strong support here in the low 100s. That's the only reason I took a risk on this stock, is just because, first of all, it is a great company, in my opinion. I like the company. I think they've already had the worst behind them. They have a lot of tailwinds coming up. I think when interest rates get lowered, more people are going to start wanting to spend a little bit more money. And the more they get cut, the more people are going to want to spend. And I don't think solar is going to be like huge, but I do think this company has a lot of rebounding to do just to get back to that small market share that they had. So that's really the only reason I'm playing this. I don't plan on holding this. This is just strictly a trade. But yeah, I mean, I'm in between 3.3% and 5.3%. If I could average 3% for 12 months, you're looking at 36% a year, which is over 3 times the S&P 500. Now, is it going to work out perfectly like this every month? Probably not. That's why I've set my goal at 2%. I feel like 2% is a very conservative goal for myself. And I'm happy with that return, 2% a month every year or every month. And if I can beat it, that's even better. So this month I'm set to beat it, which is awesome. This is my second month. Yeah, this is my second month. I think in September we did really well. I think we were up maybe $2,000 in September. We were up around like 8% in September. That was when I was wheeling Nvidia. And Nvidia, I bought in at 106 and sold it at like 126. So we made nice on Nvidia. But that's over. So we had a great September. And we're on pace to have a great October. I'm not worried about the unrealized loss. If Nvidia tanks after earnings, honestly, I'm probably going to double down and bring my average cost down. And if they spike on earnings, I'm going to get that 3.3% gain and keep it moving. But I definitely think it's possible, guys. And if you don't have an account, like, I know my account's not that big, but it could be bigger than some people's. If you don't have a big account, you could trade credit spreads. If you guys know it, awesome. If you don't, I'll do a quick explanation of credit spreads. So, like, let's just say Nvidia, for example, right? Like, wow, this stock's been pumping, right? This stock, 102 straight up to 137. Its all-time high is 140. And let's just say your mindset is, nah, Nvidia's not going to top out. We're due for some downturn. It's not going to break its all-time high. So nah, I don't think it's going to happen. You can come up. I mean, you could even play super conservative, right? I mean, November 1st, let's go right here. We'll go $12 out the money. And today is the 17th, I believe. So 2 weeks, we're going 2 weeks, and you're going to buy. So you're going to look at 2, right? I'm looking at the 149 and 150. You're going to sell the more expensive one, which would be the 149, and then you're going to go to buy and buy the cheaper one, right? All right. So you're going to look at this, okay? Worst case scenario, you lose $83. So you only need about $83 to do this trade. Best case is 17, okay? And Nvidia could stay the same. Nvidia could go down, you'll profit. Nvidia could go here, you'll profit. As long as Nvidia is under 149 in 2 weeks, you're going to profit on this trade, $17. And out of $100, $17 is 17% in 2 weeks. 2 weeks and 1 day, to be exact. So 15 days, you're making 17%. Is this a conservative trade? I would say kind of. Nvidia is a volatile stock, so it is possible it could rip up here, right? I would say if Nvidia broke all-time highs, let's just say Nvidia gets to like 141, 142, I would maybe cut my losses on this stock, or on this trade, I mean, just because when something breaks its all-time high, you don't know where it's going after that, right? There is no resistance anymore. It's kind of just, it's just going to keep going until it doesn't. But if it doesn't and gets rejected, and then it starts going back down, this is 17% in a little bit of time. And you don't even have to trade Nvidia. You could trade the S&P 500 like that. Let's just say S&P's bullish most of the time, right? So let's just say, okay, S&P's bullish like 73% of the time, something like that. Let's go out till tomorrow. So we're going to say, I bet it doesn't go down this far, right? Because most likely it's going to be bullish. And yes, this is a one-day trade, right? So you have a 50-50 shot. But if you go, the more you go out, the closer to that 73% chance of winning you get, right? So if it's bullish 73% of the time and you go out a month, you're going to be close. If you go out one day, you got a 50-50 chance. And with the way it's looking, it's been bullish quite a bit. It's more likely to be bearish tomorrow if I had to take a guess. But if you said, nah, I think it's going to keep being bullish. I mean, look, you could go down to the 74. We're going to buy the cheaper ones, sell the more expensive. Look at that. You can make 2% as long as it doesn't fall to $7.85. You make 2% in 15 days, which would come out to 4% a month if you did this trade twice. Oh, I'm sorry. 15 days. This isn't even 15 days. This is 1 day. Okay, now it's saying $1. $1 in 1 day. That's 1% in 1 day. I mean, if you did something like this in 30 days, it's 30%. Now, it's not going to work out perfectly every time, right? You're not going to win every single trade. But I'm just saying, like, this is stuff you guys could look into, right? When it's overbought, this isn't the greatest chart. But, like, look right up here. When it's overbought, it comes down. So every time it gets overbought, maybe something like, RSI's looking at, what is this, 74, something like that. When it gets overbought right around here, that would be a good time to maybe make a call credit spread, which is like, I doubt it'll go up. But look at the past year, right? We have ripped almost 35% in the last 12 months. Wow, that's pretty crazy. But yeah, you have credit spreads. If you guys don't have enough capital to sell cash secure puts, you have credit spreads. There's margin. Just be careful with margin. What else? I would say definitely credit spreads. You just have to be careful because you're risking, like, you could lose the whole trade, right? If you're doing a $1 credit spread, you're risking $100. You're risking $100. You're going to keep the credit whether you win or lose the trade. But you are risking that entire $100 for that trade. But the more conservative you do it, the better. The more likely you're going to win that trade. So 2% a month. I wonder what. I'm going to check for you the S&P 500 1 month trade, and let's see how conservative we could get. So today's the 17th, so we'll go to about the 15th, a little less than a month, and we'll say it's definitely going to be a little higher than lower, right? All right, so let's go super safe. I mean, you can go super safe. Let's go down to here. Let's go down $33. Go to the 550. So we'll sell. We'll buy. Review. All right, so the bid is $6, which is 6% because you're risking $100. So $6 out of $100, 6%. The ask is 11, so it's probably going to put you at 8 or 9 cents for the lock in the trade. Max profit $9. This is a 9% trade in a month. And I consider this to be very conservative. I mean, the S&P 500 would have to drop to under 551 for you to lose money. Which, that's about $32, which is, what, 6%? $32 from there is probably, you're looking at 5.5 to 6% in 1 month. The S&P 500 would have to drop almost 6% in a month, straight down, for you to not win this trade. The odds of that happening, I would say unlikely. I mean, we do have the presidential election coming up, so that could make markets extra volatile. But if you are in the mindset of bullish or even sideways trading, like, okay, maybe we'll just stay flat for a little while, and then before we get bullish again. If you're bearish, don't make this trade, right? If you're bearish, you're going to want to make the exact opposite trade. Like, okay, I think we're topped out. We're not doing this. If you're bullish, or even sideways trading, or even slightly bearish, this trade could come out profitable. This is 9%, and you could even go safer. It's 9%. You could even go safer than that. I mean, you go to here. You go to here, 5%. And that's even safer. S&P 500 would have to drop, what, $42? That is, I mean, you're closed in on, what, 8% maybe? 42? Probably 7.5%. 7 to 7.5% in a month downwards just for this trade to not work out for you. And it's like, if you did 10 of these contracts, make $50, hey, that's 5% a month. That's great. That's fantastic. The only thing I don't like about credit spreads is your max loss is $950, and that really is your max loss. If, let's just say, worst case scenario, the S&P tanks 8%, and you're only hedged to 7.5%, you do lose this whole entire trade of $950. You'll keep that $50 premium, but you will lose $950. So that's a little too risky for me, right? Because I have a portfolio to where I can sell cash secure puts and covered calls. I'm not going to be making 5% a month probably. I'll be making 2 to 3, but 2 to 3 is fine with me. But if you have a smaller account, this is something that I would do, right? If I had a $100 account all the way up to even like 5,000, I would say 10,000, I'd probably start selling puts. But anything under $10,000, this is what I would be doing. I would be selling, but I wouldn't go all in on one, right? Like I'd probably sell, like 20% of my portfolio in this, 20% in something else. Don't put all your marbles in one jar. But this is what I would be doing. 5% return in a month, and it's very conservative. I mean, very conservative. The S&P 500 does not be dropping like that. It does not be. We're cutting interest rates. Now, if we were to go into a recession, then maybe you could lose this trade, right? But if you believe in the soft landing, if you believe in everything that Jerome Powell is hoping for, then 5% is super conservative. And you could even get riskier. The closer you get to the share price, the more percent you get a month. But I'm a conservative person, so this would probably be a trade that I would look into if I had a smaller account. Because, I mean, the chances the S&P drops, 7 to 7.5% in the next 30 days is very unlikely. I mean, I guess the presidential election could have an effect on that. But, like, let's just say, like, November 15th through December 15th, very unlikely. Matter of fact, the Christmas rally is usually a thing. So stocks are actually pretty bullish, I think, in November and December timeframes. So, even less likely. But like this trade, you make 5% if it goes up, you make 5% if it stays the same, and you make 5% if the S&P 500 drops 6%. You still make 5%. The only way you don't is if it drops more than 7 to 7.5%, whatever the exact percentage is. So I know I've been talking about that trade for a while, but that is definitely a great small account strategy. That's what I would be doing if I had a smaller account. Definitely until I can get to over 10,000, and then I would be selling, because most stocks are around 95 to $100. You got Enphase, you got Nvidia, you got Cloudflare. What else you got? Kava, AMD. Tesla's a little more expensive. AMD's, you need 15,000 for that. So I'd say once you get to around 10,000 is where you could start really playing more conservative. But you definitely got to get to that mark first. But I think that's how we beat the S&P 500. I mean, if you want to be super conservative, I'd buy S&P 500 or VU. VU is the less expensive. And when I say less expensive, the expense ratio is a little bit cheaper, which means they take out, I don't know how to explain it. It's like they take out less money. So you keep more of your dividends, basically. Because if your dividend ratio is 0.5%, or let's just say 1% a year, and the expense is 0.03, they take out the 0.03, so you only get to keep 0.97% of your dividends instead of the full 1%. Not a big deal, though, really. But that's how you play super conservative. Call credit spreads, put credit spreads. It's definitely more risky, but when you have a small account, it's like, what can you do, right? I mean, you could buy the S&P 500 and make 10% a year, or, you could sell super conservative call credit spreads on the S&P 500 every month. Daily is more risky because, like I said, 50-50 chance if the stocks or if the S&P is going to be bullish or bearish for the day. You could just happen to hit a red day, and then you're like, oh, I lost that trade. And then the very next day, it bounces right back up and covers all of its losses. You're like, wow, if I would have just done a 2-day trade, this would have worked out because they would have canceled each other out. So, definitely like a 30-day trade is something that I'm interested in. I like to do monthly options, anywhere from 2 weeks, about 2 to 4 weeks is what I like. 2 weeks is mainly earnings trades, but 4 weeks is what I usually do. I used to do weeklies. I've gotten burned a lot on weeklies, so I'm not touching weeklies ever again, unless it's like an earnings trade and I'm bullish on the stock or bullish on the company overall, something like that. Then I would maybe touch weeklies. But I'm definitely a 4-week option kind of guy. I used to be against it, used to do weeklies, but like I said, absolutely been smoked on those. So I do monthlies now, but yeah, those call credit spreads, man, those are definitely the way to grow that small account. You do 5%. I mean, I would consider that to be a very conservative trade. You do 5% over 12 months, you're looking at what, 60% return in a year? I mean, you could grow that small account very quickly. And then once you get to the point to where you can, either just buy S&P 500 with like half of your account or something like that, or sell cash secure puts, blah, blah, blah. You could still have a little bit of change left for cover calls. And then what I would do with that change is I would be doing more spreads. So 60% a year playing super conservative. That's awesome. All right, guys, if I left out something, or if you guys also know great ways to beat the S&P 500, that's also conservative, right? Because I'm a very conservative person. I like to play it safe, blah, blah, blah. If you guys know any other good trades, let me know in the comments, man. I would definitely love to check them out. And I don't really care for the iron condors or the little butterfly strategies. It's a little not confusing, but it's just, I don't like that little window space you get. Like, you make money if the stock goes way to the left or way to the right. It's not my strategy. All right, guys, that's it for the video. Peace.